negotiating agreements for debt and equity financing. Let's say you've prepared your documentation well and have just received a loan offer from a bank. But you find the bank document complicated and confusing. How do you know if it's a good offer or if you should try to negotiate further? This lesson will help you identify key elements to review in a loan agreement and what and how you may be able to negotiate with lenders and investors. Key elements of a loan agreement. Prior to issuing a loan agreement, lenders will often send you a commitment letter that outlines the understandings reached between the parties and the terms and conditions of the loan. The commitment letter documents the loan agreement, so it's important to examine it thoroughly before signing. You might also consider asking an expert or someone with experience to help you. Remember that the loan agreement cannot be imposed on you. It's not simply a case of take it or leave it. You have the right to negotiate every aspect of the agreement. Here are some key points to review. First, check the amount and term of the loan. Pay careful attention to the schedule of disbursement and the schedule of repayment. Compare with your cash flow projection to see whether the loan offers sufficient cash at the times you need it and allows you to repay when your cash will be available. You may ask the lender to adjust the amount and term of the loan to better support your growth plan. Show them your detailed cash flow projections and clearly explain your cash need. Second, check the interest rate. Taking a loan means you want to generate more profit without adding more owner's equity. But if the interest rate is so high that the cost of the loan will eat up any additional income generated, then it doesn't make sense to take this particular loan. If the rate offered is higher than your original estimate, plot the new rate with your projected income statement to see whether you can still afford it. Obtaining a good interest rate is very important. Even an eighth of a point less can mean a significant savings over the life of a loan. Be sure to shop around and check the rates offered by other sources. The lending rate is generally regulated by the central bank, so confirm that the rate offered by your lender falls within the regulated range. If it doesn't, ask the lender to adjust the rate accordingly. You might also show the lender your new projected income statement and ask if they would consider a more reasonable interest rate for your plan. Note that businesses with greater turnover generally have more negotiating power. The rate structure is equally important. Check whether the rate is applied to the total loan amount or to the outstanding amount only. If repayment is to be made in equal installments, it's likely that the rate is applied to the total loan amount. If the total repayment amounts reduce gradually as the loan is repaid, the rate is likely applied to the pending amount only. Of course, paying interest based only on the outstanding principal will be fairer to you. Try to negotiate for this. In addition, lenders often float the rate to minimize their risk. That means the rate may not be fixed for the whole term and will change according to certain conditions. In this case, you won't know what your interest expenses will be. So, you'll have little control over whether the loan will bring additional profit. As a borrower, try to negotiate a maximum interest rate cap on any variable rate. That way you'll know your maximum exposure on the loan. You might also consider buying a fixed rate from the lender. Many banks will offer a fixed interest rate that is slightly higher than the current floating rate, for example, by an additional 0.5%. While more expensive, this can give you peace of mind and allow you to make precise projections. Let's take a break and check what you've learned. Next, you'll want to check the collateral or guarantee requirements for securing the loan. Some collateral requirements could affect your normal operations and the overall cost of the loan. For example, if you need a bigger van for your business, your lender may not allow you to sell the old one if it's already serving as collateral for a loan. Or, the disbursed loan may not be made available to you until the collateral registration process is complete. Lenders may also require a personal guarantee as a second level of security, in addition to the business collateral. A personal guarantee is a pledge by someone other than the named borrower to pay the loan if the borrower cannot. As a general rule, try to avoid providing a personal guarantee for the loan. By making a guarantee, you're putting your family's assets or those of your friends or colleagues at risk. If your business fails to repay the loan, creditors will go after you. Start looking for evidence to convince lenders that your business has sufficient collateral to secure a loan and that a pledge of personal assets is not necessary. In addition, it may be possible to negotiate other aspects of the loan in lieu of a personal guarantee, such as the following. 1. A higher rate of interest. 2. Borrowing a lesser amount. 3. Borrowing for a shorter period of time. And lastly, you may be able to obtain a financial guarantee from a reputable guarantee fund. In case of default, the fund will reimburse the lender up to a predetermined amount, for example, 50 to 75%. A guarantee fund usually charges 1 to 2% of the insured amount. If you still can't avoid a personal guarantee, after negotiating all other alternatives, try limiting the terms of the guarantee itself. For example, set a fixed amount or put a time limit on the personal guarantee asset. There are other terms and conditions that are important to review as well. Check whether the agreement allows you to buy back the loan. That means you can repay early with or without a penalty fee. Negotiate with your lender to have this option available, and if possible, without any fee. It will be helpful to have a buyback option in case you find yourself with excess cash at some point or you want to change your debt to a more competitive source. It's also important to know if there are any non-loan costs, such as upfront fees for reviewing and preparing documents, performing credit checks, or insurance and guarantee fees, etc., which can add to the overall cost of the loan. Try to negotiate to reduce any fees. It never hurts to ask, and lenders will often budge slightly. Tips for negotiating with lenders. Apart from financing conditions, Be prepared to negotiate restrictive covenants or commitments that the lender may require your business to follow during the loan term. There may be positive covenants such as you're continuing to meet financial obligations, pay taxes, maintain a positive cash flow, and business insurance, accurate record keeping, and certain levels of financial ratios. Other requirements may be negative if they limit the borrower's behavior in favor of the bank. The most common example would be to require your company not to borrow money from any other lender. You must either negotiate these covenants beforehand or comply with them to avoid any penalty the bank may impose during the loan term. Before starting any negotiation with your banker, list any covenant types that might be especially bad for your particular business. You can discuss any part of a proposed covenant in the give and take of a negotiation, but you must be prepared to offer well-considered and reasonable counter-proposals to achieve a positive result. Tips for negotiating with banks and bank-like institutions. By now, you've probably realized that doing your homework is key to a successful negotiation. You must know your business and your proposed project well and have all the relevant documents ready. You should also collect information about the competitiveness of the lending market so you know how much negotiating power you may have. And of course, practice your presentation. Imagine how you will interact with the lender and what they will ask you. Then, practice answering their questions and showing supporting documents. Another tip is to look for more than one loan commitment. Take advantage of the lock-in period, which is the lender's promise to hold an interest rate and other conditions for a specified period of time, while your loan application is being processed. The lock-in gives you time to collect and compare different loan offers. If the lender doesn't specify a lock-in, be sure to ask for it. Let's take a break and check what you've learned. Tips for negotiating with non-bank lenders. Apart from a bank loan, you may leverage other types of financing as well, such as supplier credit or leasing. These non-bank offerings are diverse and may use loan criteria that are different from bank and bank-like institutions. Supplier credit constitutes a major source of financing and involves negotiating payment terms that, in effect, provide you with more cash. You may try to get a longer payment period, a larger credit limit, or both, provided that you have established a good track record of timely payments. Vendors who feel the customer has growth potential and will be loyal may agree to even more incentives to maintain a long-term partnership. For example, ask to extend the payment period from 30 days to 45, or even quarterly to match your cash flow stream. As a small business owner, you may decide to buy or lease a piece of equipment, a machine, a vehicle, an office, or shop space. Leases are legal contracts. Be sure to examine them closely and, more importantly, ask the leasing company the right questions to negotiate the best financing terms for your company. First, there are always costs associated with the lease contract. Make sure you understand not only the leasing rate, but also all other associated fees, which often include one-time documentation fees and interim rent. If your company has many years in business and excellent credit, leasing costs should be comparable to a bank loan. If your company is less than 2 years in business and you have credit challenges, rates may be much higher. Next, examine the early termination clause. Is it possible to return the leased equipment earlier? Any penalty? If so, it may be better to look for a shorter lease term unless the lease is critical for the continuation of your operations. In addition, if you intend to buy the equipment at the end of the lease term, make sure the buyout amount is clearly predetermined in the contract. Finally, shop around. It's in your best interest to get several lease quotes and/or approvals to secure the best deal for your business. Let's take a break and check what you've learned. Tips for negotiating with investors. If you decide to use equity financing, you need to negotiate with investors. And this process is different from negotiating with lenders. Equity financing is where you trade a percentage of ownership of your business to angel investors or venture capitalists in return for their capital, almost always in the form of their cash. The investor may go beyond just investing in your business and could play a large role in running the business and deciding on its future direction. When negotiating equity, your foremost concern should be enlisting an investor who can add value to your business and keeping control of your business. Choosing the wrong investor might cost you a huge amount of money and years of frustration and disenchantment. Here are a few tips to guide you in choosing the right equity investor. First, try to accurately value the contribution that the investor could make to your company. Look at their experience in your sector and their track record of success with businesses similar to yours. A good way of doing this is to speak with other owners who have worked with them. Also, during the negotiations, be sure to ask the right questions that might help uncover red flags while not turning off the potential investor. Second, you need to know what the investor looks for in a small business and the criteria they use to make decisions so that you are well prepared to deliver a well-suited investment pitch. Investors are, in the first place, interested in your business valuation. The valuation is largely dictated by the market forces in the industry in which your business operates and the ability of your business to grow and provide a decent return on investment. Investors also want to determine the downside risk, particularly what will happen if the business does not perform as planned, and the capacity of the management team to reduce these risks. Investors will also likely negotiate to include exit terms and conditions so they can get their money out of the business if certain events transpire. Knowing your business plan inside out will help build your credibility during the negotiations. Also, be sure to prepare an investment summary that addresses all these elements and includes the amount of money that you need and the long-term value added of signing in the equity investor. Remember, equity firms will be your partners and you will have to trust them when they become part of your company. But before then, they are your opponents, and you must be careful to protect your own interest. As a rule of thumb, don't negotiate only with one private equity firm. Consider alternatives, whether they be private equity or other buyers and investors. If you only negotiate with one, you will lose negotiating power. Since an equity investment is a complicated transaction, it's good to have an experienced consultant or attorney work with you as well. Now you know what to look for in an agreement and you know how to negotiate key terms. You can feel confident speaking lenders and equity investors and asking for what you need. Take some time to note down in your growth plan your key objectives for negotiations such as interest rates and other terms and conditions.